Hi, welcome to part 2, chapter 1 of investments. And we're going to continue here with making your investment plan. So here we're going to go over some concepts of how you can get started in investing and make and basic common sense ideas for your investment process. So first, you want to develop a well thought out plan, something that's going to encourage discipline, which is key, in an approach to managing your money. So there's a certain amount of emotional fortitude you have to have in the form of discipline to continue to make regular series of investments and avoid a lot of the common mistakes many investors make when they first start out. So a good investment plan is going to be a way of setting your goals, your strategies, coming up with a plan that is going to dictate your investment decisions over a lifetime. Now, if you make the right investment choices and decisions early on, you can easily become a multimillionaire. Typically, when people first start out in investments or get interested in investments, they may be lured in by a speculative sort of situation on a low-cost trading app, such as Webull or Robinhood, and they may start trading stocks in a speculative gambling-like nature. And now, when the stock market is doing very well, it's all stocks generally are doing very well. So it's very hard for investors to make any big mistakes during this time, during a big stock market bubble or bull market. And this gives this false sense of confidence that everything I'm doing is so brilliant, I know everything, and I'm making so much money. And it just leads you down the path of taking bigger and bigger risks until one day, all your returns are taken away from you because you made one too big of an investment at the wrong time. So this series of slides is to try to give you a better perspective on investing. No investment, you should not make an investment thinking you're going to make a great return in the next couple of days or couple of weeks. Short-term investing or day trading has led many down a path of destruction and great losses. So you could be doing well for a year or two in day trading, think you're doing very well, and then just one day you lose all your gains and then a lot of your principal. So this is meant to be a more realistic, more tempered type of an approach. So you want to think about over your lifetime, you should write down an investment policy statement, which we're going to get to more specific of these things as we move through. You should consider your personal taxes, investing over a life cycle, and investing in and over the business cycle. So let's talk about each of these in a little bit more detail. So let's go right into writing an investment policy statement. So here, you're going to summarize your current situation. You're going to list what assets you own, your current income and your spending habits, and you're going to define an investment horizon. So this is very important. So what you want to do is you want to try to see honestly where you are right now. And most people probably have their spending habits about even with their current income. And what you want to do is you want to live below your means. You want your current income to always be larger than your current spending habits. And this is what's going to develop enough capital for you to invest. And you want to define your investment horizon. I suggest most people define their investment horizon as, retirement. So when you turn whatever age you want to retire, typically 65, you want to develop an investment plan to reach your goal of retirement. Your investment goal may not just be pure retirement. It may just be to become a multimillionaire. And that's going to take time, typically 20 years or more. So when you specify your investment goals, you have to think about what is your financial objective. Do you want to have $4 million? Do you want to have a certain amount of money for retirement? So what is your objective here? And then you want to think about your risk. What is your tolerance for risk? Typically, if you're starting out and you have a longer time horizon, your risk tolerance can be a little bit higher. But you certainly don't want to put yourself in a situation where a market crash could steal 50% of your investing principal. So you have to really think about, and through this series of lectures will be more perspective will be given on how to set your risk tolerance and how to understand your risks. And then, set an investment selection guideline. What investments are you going to consider and how will you select them? How will you monitor them. So there's going to be some sort of responsibility for the way you select and monitor your investments. Now, the key in monitoring is you don't want to monitor every day, every couple of hours the market's open. If your investment requires daily monitoring or weekly monitoring or even monthly monitoring, it may be too risky, too speculative, too short-term of investment. Typically, a good monitoring of your investments is checking back in every quarter, every 6 months, in an extreme case, every year, and reallocating or redeciding where your money should be in your asset allocation or adding new assets to the mix, and those types of monitoring time selection and monitoring timelines. Now, as far as personal taxes, and again, this depends on where you live, what country, what state, because there is a lot of taxes associated with assets. So, and taxes will come down to a city level, a state level, a federal level. So you got to understand how your investments will be taxed. How is the income your investments generate? How's that going to be taxed? How will the sale of your investments be taxed? How would the ownership of your property be taxed? For example, if you own real estate, you're probably paying annual taxes on that real estate. And those are taxes whether you make a profit or don't make a profit, whether you buy or don't sell, you owe these, municipal property taxes. Now, there are three basic categories of ordinary income. And they're all taxed differently. And again, this depends on where you're living because tax laws change all the time, and taxes are certainly different between the location of where you're living. But by and large, there's active income, which is income from working, salaries, wages. And this active income is the type of income that gets taxed the heaviest. So where I sit, if I earn $1, I'm going to be paying state tax. I'm going to be paying city tax. I'm going to be paying federal tax. I'm going to be paying a Social Security tax. I'm going to be paying a Medicare tax. So all these taxes, after they're taken out, I may only have about 60 cents on each dollar I earn because active income from working is taxed so heavily. Now there's portfolio income, income from investments, the interest, the dividends, the capital gains, and it depends on where your portfolio exists. If your portfolio exists in a tax-deferred account, like a 401k, then you pay no taxes while it's inside that account. You only pay taxes if you withdraw the money outside of that account. If you have a regular brokerage account, then you are paying a lower tax rate on interest, dividends, and capital gains, depending on the type of investment you own. So you always want to look up, if I do buy this investment, what are the tax ramifications of it? Now, there's also passive income. So this is income generated from, say, rent is a very common one, royalties, a limited partnership. These are where you're really not doing any work and the money's just rolling in. And these are also taxed at very different rates as well. And this is passive income is some of the greatest income because it just keeps reoccurring and you don't have to do anything. So most taxing bodies will tax in a progressive rate system, meaning that tax rates will go up the more you make. So let's look at an example of, here's an American tax system, and the tax brackets do change quite often. So this is not written in stone. This is just really an example. It's close to what things are today. So what we're saying here is, depends if you're an individual or maybe you're filing jointly like a married couple. So we'll stay with the individual. You're just single filing by yourself. Everybody who's single, the first $9,525 they make only gets taxed at 10%. As they start making more money, any money you make beyond $9,526 up to $38,000 gets a 12% rate. It doesn't mean you're paying 12% on all your money. You pay 10% in the first $9,000 and then 12% up to from $9,000 to $38,000. So there's about $28,000 bracket there where you're paying 12%. Then when you start making more than $38,000 up to $82,000, you pay 22%. So this progressively gets higher as you're moving up in your tax rates. Now again, these tax brackets change quite often. So, and this is just a federal tax bracket. You have a whole nother set of tax brackets for the state and maybe also a city. Okay. So this is why you really got to understand the tax laws of where you are. Now, let's break out the taxes a little bit more here. So you have your capital gains and capital losses. So for the capital asset, so this is, some kind of property you're going to own as a taxpayer. And this could include, we're going to stick to stocks right now as a capital asset. So you invest, we'll say you buy one share of stock for $1,000. That's your capital asset. Now, a capital gain is going to be if you sell that asset for anything more than $1,000. You sell it for $1,500. You have a $500 capital gain. So that means the profit you made from buying and selling the asset. Not looking at dividends, not looking at interest, just the asset itself. Now, if you hold the asset for more than a year before you sell it, it's considered a long-term asset. And in the United States, long-term assets have a tax advantage, and you pay a much lower rate of tax on the long-term asset than you do in a short-term asset. Now, if you have a short-term asset, something that's less than a year, you're just going to pay whatever your ordinary tax brackets are. So the capital gains you make go on top of your ordinary income from wages and gets taxed typically at the highest rate. So that's why you don't want to buy and sell a stock for a gain with under 12 months, because you really do lose a larger percentage of that gain to taxes in the United States. And if you are a very wealthy investor, there's an additional Medicare tax for people who are higher earners, which is a 3.8%. Very few people are going to fit into this category of a very high income that has to worry about this additional Medicare tax. Now, a capital loss is when you buy an asset like a stock, say for $1,000 per share, and then the stock price goes down. And then you sell it at a loss. That would be a capital loss. So capital losses you can use to lower your income tax, but that's limited to only $3,000 per year to offset ordinary income, such as wages. So you can make a capital gain of any amount. You're going to be taxed on that full amount that year you make the gain. But for a capital loss, you may have a $10,000 capital loss, and because of that capital loss, it may take you 3 years or longer to fully deduct that from your taxes. Okay, so if we look at long-term capital gain structures, and these rates do change. They're not always identical. So we're just kind of using this as an example. But typically what they have is they have a 3-tiered rate, 0, 15, and 20%. So if you make less than $38,000 in your regular income for individuals, joints or higher, you're going to pay 0 tax on your capital gains if you make a low income. If your income is between $38,000 to $425,000, your capital gain is going to be limited to 15%. So that's a lot less than, if you're making, you could be in a 30% tax bracket. And if you have a capital gain, you'll have to pay 30% of your gains that year if it's a short-term investment. So that's why you want to have these long-term investments help reduce the amount of taxes you pay. Now, if you make over $425,000 a year, God bless you, you're going to be put into the 20% capital gains, long-term capital gains rate, which is still going to be significantly less than the 36 or 39% you may pay in your top bracket. So again, that's why it's great as a low-income individual when you're first starting out. Maybe you're a student in college and you're making definitely below $38,000 a year, and you have some long-term gains. You can get 0% tax rate on those, which is really fantastic. Now, these are federal income. You still could be subject to state taxes as well. But again, this is an attempt by the government in the U.S. to increase incentives for longer term investments. They don't reward short-term investing, day trading, have very high tax consequences. So longer term investing already by itself gets a tax advantage. And that's one reason why longer term investing typically has a higher rate of return than short-term investing. Okay. So as far as your tax planning goes, you want to look at, what your current income is, your projected income in the future, and develop some sort of strategies to minimize your tax effects. So if you have a particular year where you're not earning a lot of money, it might be a good time to cash in on those gains to lock them in at a low tax rate. And then later on, if you wanted to, when you retire, you might be earning less, have much less active income, and it's a good time to sell your investments as well and capitalize on those lower taxes. And you certainly want to space out your capital gains each year, because you don't want to have all your capital gains in one year, which could push you to pay more. It might be a year where you pay more taxes. So you really should think about the tax side of your investing and trading while you're investing in stocks. And you want to take advantage of any tax advantage retirement savings plans that may be offered by your employer, your state, your country. And in the US, we have the 401k. We also have a 403b, and we have IRAs. These are all different tax advantage retirement savings plans. So basically what they say is invest your money in, if you invest your money in an IRA or a 401k, you get an immediate tax deduction on that money, meaning that if you invest $20,000, you don't have to pay any state or federal tax on that money. So already you're up like 20-30% on that investment. You only pay taxes when you retire and take the money out of those accounts. And in the life of those accounts, the 401k, the IRA, they'll generate, as you're generating dividends, as you're generating interest, as you're generating capital gains in those accounts, you pay no taxes until you retire and withdraw funds. Then you'll pay taxes on the funds you withdraw. For a Roth IRA, this is a little bit different. You pay taxes, you put the money in the Roth IRA. Over the lifetime of the Roth, you pay no taxes. And then when you retire and take money out of the Roth, you pay no taxes. So it's another aspect. And probably if you're young and you're starting out, you should have a mix of these tax deferred accounts and the tax free account. So a Roth IRA, you pay tax up front, and then it's a tax-free account for the rest of the Roth IRA for the rest of your life. But you're putting money in that's already taxed. So you get the advantage of not paying tax on any capital gains later. So these are things that, as they're come available to you, you want to look into a little bit more and get a better idea of how these could benefit you. It's also key to consider your life cycle, your time horizon, and where you are in your life. So investors can be put into three basic philosophies. So if you're relatively young, under 45, so most people start investing around age 20 and they move up from there. In this phase, you want to be more growth oriented. You want to take some more risks, buy some more growth oriented companies, and really look to expand on the returns of your investments, because you have a long time horizon to mitigate any stock market crashes or corrections or any mistakes. As you become more middle-aged, 46 to age 60, you want to take a little bit more conservative approach, where you're still making investments and you're still taking on risk, but you're trying to mitigate some of those risks and not really move into the riskiest companies or spaces, because you want to guard your principal a little bit more. And as you become of a retirement age, 61 and older, you want to switch your retirement to lower risk, higher income types of investments to help pay for your retirement and provide income during your retirement. Now, so you can understand how this is sort of, you're changing your investment and your investment goals and strategies as you age. So you can take more risks and be more speculative as you're younger. And as you get closer to retirement, you want to shift your portfolio to more safer, reliable investments to protect your principal and maintain a source of income for yourself. Now, one thing to keep in mind, that the stocks don't just go up in a direct line. They're affected by the business cycle. So conditions in the world economy and the US economy are going to greatly affect stocks in general. So business cycles are a normal cycle of how the economy works, where you have periods where the overall domestic products are increasing, economies are increasing. So strong economies definitely aid to expanding stock market prices and stock prices, because strong economies help companies make more profits, and more profits help stock prices increase. So when you're in this expanding business cycle, it's very good for stocks and typically good for bonds too. But with a business cycle, there could be a downturn. And when the business cycle turns downwards, and that's called a recession, typically stocks and bonds will suffer to different degrees. But if you're investing in the long term, you shouldn't worry about these business cycles or market cycles. They're just opportunities to buy more stocks at lower prices. And typically the biggest mistake is to sell your stocks during a downturn or during a market correction. They're typically good opportunities to expand your investments into stocks and get them at lower prices, lower valuations. If we look at, here's an interesting stock performance. If we look at before and after recession, so if we look at the returns of the stock market 6 months before a recession, and then the returns of the stock market during the recession, and then 12 months after the recession. So you can see in most cases where at 12 months after a recession, stock markets do pretty well. But before and during recession, stock markets can suffer. But you can see how there's enough of a variation here that you can't always make a definite, definable approach to how much you're going to lose and how you're going to invest. There are some recessions where stock prices actually go up. And, there's some situations where the economy is contracting and stock prices are going up. So it's not always 100%. And it's really difficult to tell exactly where stock prices are going. If you look at a long-term trend, we see that stock prices are trending upwards in the long term. And that's why we want to stay long-term investors to take advantage of this increase over time, not really worry about these small changes year to year. Now, as far as liquidity needs, if you need money or possibly need your money in a pretty quick turnaround, you want to think of more liquidity-oriented investments, which would be short-term investments. So short-term investments are going to be good for people who don't want to lock their money up for long periods of time, that want to have their investments in a way that they can get that cash out pretty quickly. So the role of short-term investments is really, to provide you a pool of money you can safely access without penalty quickly. So the problem with stocks is if you put money in the stock market and the stock market goes down 30%, you don't want to take money out at that point. So it's not so liquid. In some occasions, it could be a bad timing to take money out of the stock market. So this is why these short-term investments, where you can put money in a security that's a short term, has a low rate of return, but the money's very safe. You're not going to lose, your principal. So it has a high liquidity, a low risk of losing your money, but it's also going to have a much lower return. And it may even be lower than inflation. So it's not a good long-term strategy, but it is good for short-term funds. Now we can look at different types of short-term investments. We could have basically a savings account, different types of checkings accounts, direct deposit, a money market account. These are all different ways you can put money in a short-term investment. Now, some of these short-term investments that would be managed more closely by a money manager may have minimum requirements to start your investment. And then the interest rates are going to be slightly higher than what you would get, say, just holding your money in cash. And, there is federal insurance that if the bank goes bankrupt or that the government will step in and secure these accounts up to a certain amount per deposit, which is very reassuring in times of distress or trouble where you're worried about an institution like a bank going bankrupt and stealing your money. So the government, uses these insurance to really inspire confidence in these short-term investments. Now, as far as federal, this would be really deposit type accounts like a savings account. A federal account would be Treasury bills. These are less than 1 year. There are Treasury bonds that you can invest in the short term, and they're liquid, but they're a little bit riskier than, say, the Treasury bills, which are less than 1 year. So they pay a lower return, but they have lower volatility. Okay, so let's move on to non-government issues. So these certificates of deposit, this is something that a bank would issue that locks your money up for longer than a month and pays higher interest. There's commercial paper, which is issued by companies. So companies issue bonds that are riskier, but they can also pay a higher rate of return. There's bankers' acceptances, which are something to guarantee a customer's money if it's loaned in an account or in a protective account over a certain period of time. And there are money markets, which are like mutual funds of short-term investments that provide liquidity, provide a higher return than the bank account. And they can really, these mutual fund managers are professional managers who manage your money with the idea of it being invested in the short term with a slightly higher return but much lower risks. Now, if we're talking about, meeting the liquidity needs with short-term investments, these short-term investments are basically, you are getting safety, but you're giving up high yields and high returns. So the trade-off is that my money is safe. It's not going to lose any value. It's not going to go down by any amount, but I'm going to really greatly reduce my return. So yield is what we say is the sort of like the interest rate that the return's going to give you. Now it's important because you want to look at that yield in relationship to inflation. And as a component of your portfolio, this yield hopefully can meet or exceed inflation. Otherwise, your money is going to start devaluing. So to decide what securities are the most appropriate, you have to really look at the characteristics, the availability, the safety, the liquidity, and the rate of return to get an idea of where you want to invest your money, whether it's the short term or the long term. But in the short term, you can look at different types of accounts. And here we list the different types of investments that we talked about before. And we could grade them in availability from how easy it is to get, to qualify to invest in, also minimal investments required to start one of these accounts. The safety, how safe they are as far as, guaranteeing your return. Liquidity, how easy it is to buy and sell them. And then the typical rate of interest, and this is in the year 2018, that they would have. And you see they vary quite a bit. So there is a lot to learn about short-term investing and a lot of variation between what you can make in your returns. Typically, in this low-rate environment we've been in for a while, it's hard to make any significant returns in the short term. This is a consequence of governmental policy lowering interest rates around the world. And it's one of the reasons it's forced a lot of this money into longer term markets like the stock market, which is, again, has fueled bubbles in both the stock and bond markets, the shifting of a lot of money that would normally be safe in these short term investments being placed in longer term investments because there simply is little to no return in these short term investments. Okay, let's switch over now to another reason you might be involved in this lecture series, in this course. It may not be specifically just the goal of learning about investments. It might be also enhancing your knowledge for the sake of getting a better job or career in finance. So people who have a good understanding of investments, there are different financial jobs you can qualify for with a strong understanding or knowledge of investments. So some of these industries that are more investment oriented would be commercial banking, corporate finance, financial planning, insurance, investment banking, and investment management. Let's take a closer look at each of these. So commercial banking, this is going to be, you're going to be employed by a bank, and banks are involved in investments. Oftentimes banks make investments, so they need analysts and financial people to review them. Many times banks analyze investments, so they may loan money to somebody who's going to invest in a business or an investment. You need to analyze the risks of that before the bank loans the money. So commercial banking, there's a lot of jobs available for people who are investment oriented. Corporate finance is also an area where investment oriented people could work in. This requires, understanding of the functional areas of business, because business is basically an investment. And large businesses do buy other businesses, they do mergers and acquisitions, and they have to understand the possible risks and returns of making those investments. So there are a lot of investment-oriented jobs at the corporate finance level. In financial planning, this is where you become a professional that requires certain certifications from the government where you can help other people do their financial planning. So you become a financial planning expert, and you can meet with ordinary people who need some help in understanding investments and what's the best investment plan for them. Insurance is also involved in a lot of risk management or asset management, and insurance companies are involved in investment products and investment orientation. So people with investment knowledge typically do well in insurance companies. And there's also investment banking, which is an organization that basically assists in raising capital and managing capital for large capital owners, such as other corporations or even governments. So the investment bank there's a huge amount of job opportunities in the investment bank area, but these jobs are often very sought after, and very high paid. So the competition here is probably the fiercest to get a job in the investment bank area. Now, investment management is going to involve it's similar to financial planning, but financial planning includes a whole host of individual financial planning, including budgets, including personal budgets, including spending plans, including credit card strategies and debt strategies, where investment management is specifically just involved in managing investment money for people. So you can be a chartered financial analyst. So the CFA is a good way to really say that you know a great deal about investment management, and CFAs are an international designation. And this is, investment management. People could work for mutual funds as well as working for wealthy clients. But typically you're looking to manage investment monies for large pools of investments like hedge funds or mutual funds. Now let's look at some of the salaries. This is based on 2018. These salaries have gone up as it's been a while since it's been 2018, but this is the last year of the data. So this is the years of experience you typically would need before being considered for these jobs. So you can see as the experience years go up, the pay goes up. So you could start out as a commercial credit analyst at around $50,000, or a junior financial analyst at around $55,000. And as you become a senior analyst, you're going to move up to closer to $100,000. There are loan officers. Loan officers can be very lucrative as you become a more senior loan officer. As you become, assistant controller is more of an accounting job. Investor relations director, treasurer, chief financial officer is probably one of the most lucrative jobs, but there's not a lot of those jobs available, So it's the one great thing about finance. You may start out, doing well, but typically the higher end, the salaries you can make. For example, if you're a managing director, a financial managing director with 18 years experience, you're talking about compensation above $800,000 in the millions. Now, being just a regular investment bank analyst, you can start out around $80,000. An investment bank associate starts going into the six digits, around $130,000 after only 3 years experience. And then a managing director at an investment bank, that's when you can make some serious money. As far as investment management, if you're a securities analyst, these are all six-figure jobs. Investment specialist, a portfolio manager, investment operations manager. These are all things that, are going to require some experience. So you start out as a regular analyst somewhere, and then hopefully move into securities analyst once you're proving yourself as an analyst, a financial analyst. And, you can find more data about this at salary.com. Here's another link where you can find more news about e-careers in finance. So finance has a huge amount of job opportunities in many, many different areas for students. So it's a great opportunity to really enrich yourself with a base salary, because financial jobs are the type that have the highest pay on the more experience you have in the finance. As you move up in finance, you typically get a much more higher pay than other business disciplines. So investments is definitely a great area for learning, applying your skills. And it's good for people who have a curiosity, who have an interest in making money. You can parlay that not just into your own personal investments and your own personal retirement portfolios, but into a career, a very satisfying and a very lucrative career as you move on into investment-oriented jobs. So these are really the two reasons for watching this video series, for taking this course, is to learn about investments for your own personal information that make it easier for you to gain wealth in your future, but also to learn about investments to have it as a knowledge base to utilize for future jobs that in future careers you may go into. Okay, this concludes chapter 1 of investments. I hope you enjoyed our time together, and I look forward to talking to you soon.